It usually arrives on a Tuesday. For some reason, the bank's automated mail systems are programmed to dispatch the bad news at the beginning of the week, so it lands in your mailbox just as you are recovering from the weekend. You come home, tired from a job that feels less secure every day, and you see the envelope. It has the logo of the institution you have banked with for a decade, the institution that holds your mortgage. You know your 5-year term is maturing next month. You have been dreading this moment, bracing yourself for the rate hike. You have done the mental math. You know your payment is going to jump from $3,000 to $5,000. You have prepared your budget. You are ready to sacrifice. You tear open the envelope, expecting to see a grid of renewal options, a 1-year fixed, a 3-year fixed, and a variable rate. You are looking for the damage, but you are also looking for the solution. But there is no grid. There are no options. There is only a single, sterile paragraph written in standard corporate font. It reads, "Dear client, following a routine review of your file and current market conditions, we regret to inform you that we are unable to offer a renewal of your mortgage facility at this time. The outstanding balance of $840,000 is due in full on the maturity date. Please make arrangements to pay out this amount." You read it twice. You think it is a printing error. You have never missed a payment. You have a credit score of 780. You are the definition of a loyal customer. You call the branch. You wait on hold for 45 minutes. When you finally get a human on the line, the voice is polite, detached, and utterly unhelpful. They tell you it is a business decision. They tell you the bank is reducing exposure in your postcode. They tell you that you have 30 days to find nearly $1 million in cash. This is not a rate hike. This is an eviction notice disguised as a financial letter. We are witnessing a new, darker phase of the Canadian housing correction. The narrative has shifted from "how much will it cost" to "will they let me stay?" This is the era of demarketing. This is the era of the client purge. For the last 6 months, we have watched the layoffs and the fire sales, which were loud and visible events. But the renewal denial is silent. It happens behind closed doors, one family at a time. And it is the most efficient machine ever invented for generating homelessness among the middle class. The banks are not just raising the price of admission, they are closing the theater. And if you are holding a ticket that expires in 2026, you might find yourself standing on the sidewalk, locked out of the asset you thought you owned. To understand why a bank would fire a paying customer, we have to strip away the illusion of the relationship. You do not have a relationship with your bank. You have a contractual obligation attached to a collateral asset. In a bull market, when prices are rising, the bank views you as a revenue stream. They want to keep you forever. They will fight for your business. But in a bear market, during a credit contraction, the bank views you entirely differently. They do not look at your income. They look at the asset, and more importantly, they look at the risk weighting of that asset. This is the technical mechanism that is destroying thousands of homeowners right now. Risk-weighted assets, or RWA, under the banking regulations set by OSFI and international standards known as Basel III. Banks are required to hold a certain amount of capital in reserve to protect against potential losses. But this capital requirement is not a flat rate. It fluctuates based on the risk of the loan. Here is the math that is killing you. In 2021, you bought a home for $1.2 million with a 20% down payment. The mortgage was $960,000. The loan-to-value ratio, or LTV, was 80%. In the eyes of the bank regulator, this was a safe loan. The risk weight was low. The bank only had to hold a tiny sliver of capital against your mortgage. It was profitable and efficient. Fast forward to today. The market in your suburb has corrected. That home is no longer worth $1.2 million. It is now appraised at $900,000. But you still owe roughly $900,000 because in the early years of a mortgage, you are paying mostly interest. The LTV is now 100%. The equity cushion, the bank's protection, has evaporated. Suddenly, the risk weight of your mortgage skyrockets. The regulator's formula dictates that the bank must now hold 3 or 4 times as much capital against your loan to keep it on the books. Capital is expensive. Holding that capital destroys the bank's return on equity. Even if you are paying the interest on time, The mere existence of your loan is dragging down the bank's profitability metrics. You have become a capital inefficient asset. The bank's algorithm flags this. It does not care that you are a nice person. It calculates that the cost of holding your risk exceeds the profit from your interest payments. So, the bank makes a cold, rational calculation. It is cheaper to kick you out than to keep you. By denying your renewal, they force you to take your debt elsewhere. When you leave, their risk profile improves, their capital requirements drop, and their stock price stabilizes. They are cleaning their balance sheet by wiping out your financial future. So, you receive the letter. You are panicked, but you tell yourself, it's okay, I'll just go to another bank, or I'm a good borrower. You walk across the street to the competitor. Let's say you move from TD to Scotiabank. You sit down with the mortgage specialist. You show them your pay stubs. You show them your perfect payment history. You ask for a mortgage to pay out your old bank. And this is where you hit the stress test wall. The Canadian banking system has a rule called B20. It requires that any new mortgage application must be stress tested at a rate of roughly 2% higher than the contract rate. When you switch banks, you are considered a new applicant. You do not get grandfathered in. In 2021, you qualified at a stress test rate of 5.25%. Today, the contract rate is around 6%. That means the stress test rate is 8%. But you have to prove to the new bank that you can afford the mortgage payments as if the interest rate were 8%. But your income has not increased by 40% in the last 5 years. In fact, your disposable income has shrunk due to inflation on food, gas, and utilities. You run the numbers. At 8% interest, your debt service ratios, the GDS and TDS, are blown out of the water. You simply do not qualify for the loan you have already been paying for 5 years. The mortgage specialist at the new bank looks at you with pity and says, "I'm sorry, we can't approve this. You don't pass the test." Now, the panic turns into terror. The big banks are closed to you. You are technically solvent, but regulatory insolvent. You have 30 days left on your letter. You start looking down the food chain. Now, you call a mortgage broker and ask for alternative lending options. You are entering the world of B lenders, private funds, and credit unions. The broker finds you a B lender who is willing to take you. They don't have the same strict stress test, but they have something else. The appraisal trap. The B lender orders a new appraisal of your property. They are not going to use the inflated value from 2021. They are going to use the liquidation value of 2026. The appraisal comes back at $900,000. The B lender says, "Okay, we can lend to you, but we have a policy. We only lend up to 80% of the value of the home. That is our risk limit. 80% of $900,000 is $720,000, but you owe your old bank $900,000. There is a gap, a shortfall of $180,000. The broker tells you, to close this deal, you need to bring a certified check for $180,000 to the lawyer's office on closing day, plus the lender fee of 1%, plus the broker fee, plus the legal costs. You look at your savings, you have $10,000, you look at your RRSPs. They are down because the stock market is volatile. You look at your credit cards, they are maxed out, you do not have $180,000. You cannot bridge the gap. The B lender offer is useless to you. It is a lifeline that is too short to reach the drowning man. This is the moment the foreclosure trap snaps shut. You are trapped in a house you cannot refinance, with a mortgage you cannot renew, facing a deadline you cannot meet. The days tick down. The maturity date arrives. You default. You haven't missed a monthly payment, but you have failed to pay the principal demand. In the eyes of the law, it is the same thing. You are in default. Your old bank wastes no time. They have already classified you as a non-core client. They transfer your file to the legal recovery department. They issue a statement of claim. They start the power of sale proceedings. In the United States, foreclosure can take years. People can live in their homes for 2-3 years without paying. In Canada, the power of sale process is brutal and swift. In some provinces, you can be evicted in as little as a few months. The bank takes possession. They change the locks. They put a for sale sign on the lawn. But here is the final insult. The bank does not care about getting the best price for your home. They are not incentivized to wait for the market to recover. They just want to recover their capital and move on. They want to clear the risk-weighted asset off their books before the next quarterly report to shareholders. So they list the house for a quick sale. They list it at $850,000, $50,000 below market value, to trigger a bidding war that never comes. They sell it for $850,000. Let's do the final math of your destruction. Sale price, $850,000. Real estate commissions, 5%. And legal fees, $45,000. Net proceeds, $805,000. Mortgage, owed, $900,000. Shortfall, $95,000. You have lost the house. You have lost your original deposit of $240,000. Or you have lost all the principal you paid over 5 years. And now you still owe the bank $95,000. This is the deficiency judgment. In Canada, mortgages are generally full recourse, except in specific cases in Alberta and Saskatchewan. This means you cannot just walk away. The debt follows you. The bank will sue you for the $95,000. They will garnish your wages for the next 10 years. They will seize your car. They will put a lien on any future asset you try to buy. You are not just homeless. You are an indentured servant to a debt for an asset you no longer own. Why is this happening now? Why are we seeing a surge in these letters? It is because of the wall of maturities. In 2021, during the peak of the pandemic housing boom, banks were handing out mortgages like candy. They were competing for market share. They lowered their underwriting standards. They ignored the risks because money was free. Now, 5 years later, that massive vintage of loans is maturing all at once. The banks know that a significant percentage of these 2021 loans are toxic. They know the borrowers bought at the absolute top. They know the properties are underwater. The banks are proactively pruning their portfolios. They are using the renewal date as a guillotine. They are targeting specific demographics. Real estate investors with multiple properties are getting hit the hardest. If you own 3 condos and they are all cash flow negative, the bank views you as a systemic risk. They will cut you loose on all 3 properties simultaneously. Self-employed individuals are also in the crosshairs. If your business income has dropped due to the recession, the bank will use that as an excuse to deny renewal, even if you have never missed a payment. This demarketing strategy is a way for the banks to transfer the bag to someone else. They want the B lenders or the private market to take the toxic waste. But the B lenders are full. Goodness, the private funds are frozen, as we discussed in our previous coverage. There is nowhere for the waste to go, so it spills out onto the street in the form of forced selling. This creates a feedback loop that destroys the entire market. Every time a bank forces a renewal denial and triggers a power of sale, that house is sold at a discount. That low sale price becomes a new comparable for the neighborhood. The next day, the bank's algorithm updates the value of every other house on that street based on this new low price. The LTVs of all the neighbors instantly get worse. Their risk weights go up. So when the neighbor's renewal comes up next month, the bank denies them too. It is a contagion. The bank's attempt to protect itself actually accelerates the crash of the asset class it relies on. It is a self-fulfilling prophecy of doom. We also need to talk about the shadow inventory that this creates. Right now, you look at the MLS listings and you see high inventory, but you are not seeing the whole picture. There are thousands of homes that are currently in the pre-foreclosure phase. These are the people who have received the denial letter but haven't been evicted yet. They are scrambling, calling brokers, trying to find money that doesn't exist. These homes are not listed yet, but they are destined to hit the market in the next 3 to 6 months. This is a wave of supply that will hit exactly when demand is at its lowest. When this shadow inventory becomes visible, it will break the psychological floor of the market. And where is the government? Where is the consumer protection? The sad truth is that the government is more concerned with the solvency of the banking system than the solvency of the homeowner. The bail-in regime means the regulator's priority is to ensure the banks don't fail. If that means allowing the banks to aggressively shed risky clients to preserve their capital buffers, the regulator will look the other way. They will call it prudent risk management. You call it losing your life. There is also a psychological element to this trap. It relies on your shame. When you get rejected by your bank, you feel ashamed. You feel like you did something wrong. You don't tell your friends. You don't post about it on social media. You suffer in silence. The banks count on this silence. If everyone who received a denial letter marched on the headquarters of TD or RBC, there would be a revolution. But because it happens individually, in the privacy of your kitchen, there is no collective action. The isolation is part of the mechanism. So, if you are watching this and you have a renewal coming up in 2026, you need to wake up. The passive strategy, waiting for the letter, is a suicide mission. You have to assume that the bank does not want you. You have to assume that you are on the cut list. What can you do? Action number 1. Order an independent appraisal today. Do not rely on Zillow. Do not rely on what you think your house is worth. Pay a professional to give you the cold, hard number. If you are underwater, you need to know now, 6 months before the renewal date. Action number 2. Consolidate your cash. If you have any liquid assets, do not spend them. You might need that money to bridge an appraisal gap if you are forced to switch lenders. Cash is your only shield against the equity gap. Action number 3. If the numbers show that you are underwater and you cannot pass the stress test, you must consider the preemptive sale. Selling your home voluntarily is painful. It is tragic. But it is infinitely better than a power of sale. When you sell voluntarily, you control the showing times. You stage the home. You negotiate the price. You minimize the damage to your credit score. When the bank sells it, they strip mine your equity and ruin your financial reputation for a decade. Be the first to capitulate. In a crashing market, the first seller gets the best price. The last seller gets zero. The era of loyalty is over. The social contract between the bank and the homeowner has been broken. For 50 years, the deal was, you pay us interest, we let you keep the house. That deal has changed to, you pay us interest, and if your asset drops in value, we destroy you to save our quarterly bonus. This is the ruthlessness of a deleveraging cycle. The math does not care about your memories in the house. It does not care about your children's school district. It only cares about the risk weight, and right now, the Canadian homeowner is the heaviest risk on the balance sheet. The renewal denied letter is the ultimate notification that the party is over. The music hasn't just stopped. The bouncers are physically throwing people out of the club, and they are starting with the people who thought they were VIPs. If you haven't received the letter yet, check the mail. It's Tuesday, and the bank has a lot of envelopes to send. Subscribe to Canada Property Watch. We are the only channel telling you the truth about the demarketing campaign. We will keep exposing the strategies the banks use to protect themselves at your expense. The storm is not coming. The storm is inside the house.